Okay, everyone. We're doing chapter 12 today, right? Let me see. Okay, first question 37. This company is considering replacing an old machine that is currently being used. The old machine is fully depreciated, but it can be used for another 5 years, at which time it would have no terminal value. And this company can sell basically this old machine for $60,000 on a date that the new machine is being purchased. If the purchase occurs, the new machine will be acquired for a cash payment of $1 million. Because of the increased efficiency of this machine, estimated annual cash saving is around $300,000, which can be generated during the useful life of 5 years. The new machine is not expected to have any terminal value. So they require a return of 12%. What is the NPV of replacing the old machine with the new machine? Sounds like finance. So, net present value. So as I mentioned earlier, there's an initial investment value and there's an annual saving. And you gotta find, so this is the future value. You gotta find the present value factor using the chart they gave you to find your present value. So it's saying that it needs to spend $1 million to purchase this new machine, but then the old machine can be sold for $60,000. So the future value is basically this. Is it 1 million or 10 million? 1 million. Sorry. So that will be your future value because they will be selling the old machine and buying the new machine a couple years from now. Oh, they're buying it now. So the present value factor is basically 1 since they're buying it now. Annual saving for the next couple years is $300,000. And they're saying that the useful life is 5 years. So if you go back to your, basically the chart, and you'll find your present value factor is, what is it? Let me don't confuse you guys. After you know this factor, it basically tells you the present value, basically this times this. And your present value is and for this it would be, and since you're paying it out, this is a negative and this is a cost saving, so it's positive. You add them together, which would be, this is your NPV. So basically understanding what is cash outflow, what is cash inflow, find the present value factor, and then you will get it. Gotta learn how to read the chart. Make sure you read the right line. Second question, what is the internal rate of return? Whoa, internal rate of return. What does internal rate of return mean? Anyone know? Yep, basically. So it's the rate of return that will make your NPV equals 0. We do this. So basically, if your NPV equals 0, it means that your annual saving needs to be this amount, right? Because if you add this together, it will give you 0. So when you calculate your, it's basically, oh shoot, 300,000 times whatever factor you'll get should equal to this. And your factor will be 3.1333. If you go back to your chart, you look for the factor, and then you look for 5 years. It should give you, the IRR to be around 18, a bit smaller than 18%. So you're going to go back to your chart. Your IRR should be a bit smaller than 18%. If you guys know how to do it on a spreadsheet using Excel, if you took B09, then it should be around 17.913. But having this is sufficient. Last question. What is the payback period? Oh, this is so finance. What's payback period? So how long it takes for you to get the money back, basically, and you don't consider the present value or the how time value of money. This is easy. So payback period, basically how long it will take you to recover that cost. It will just basically be divided by, which gives you 3.13 years. Next question, 44. Okay, so this company is negotiating with a major hardware chain to supply a heavy-duty sprinkler head at $18,000 each year for 5 years. This company would need something at a cost of $20,000 to fill this order. Incremental costs associated with this order, in addition to retooling costs, will be $12,000 per year. In addition, existing fixed overhead costs will be allocated among irrigation supply product, which will result in a $1,000 overhead charge against a special order. For income tax, this cost will be depreciated using a straight line method with no terminal value, ignoring the half-year convention. So the marginal tax rate is 25%. Assume that all cash flow except the initial retooling costs occur at the year end. The company's discount rate is 16%. So create a timeline showing the relevant cash flow for this problem. There's a lot of costs they gave you. It's important for us to understand what cost is relevant, what is not, and when are they occurring. So let's take a look. Can you guys see? They're saying it there. So each of the 5 years. So we have year 1 to 5. And then at the year end, which is time 5 or year 5. So what cost did they give us? The first one, they told us The sprinkler head at $18,000 each year for 5 years. And then they gave us a number that the cost would be $12,000 per year later on. So we know, okay, let me lay it out for you so you guys understand what's going on. Incremental cash flow, which have your operating income and your taxes. So it said $18,000 each year and the cost is $12,000. So your operating income from year 1 to 5 is basically $6,000 per year. Okay, what other number did they give us? We see before the $12,000, they tell us the cost is $20,000 to fill this order. This is a negative cash investment at time 0. And later on it says for income tax, the retooling cost would be depreciated using a straight line method. So it's basically saying for this part, your tax would be, your retooling cost is this, straight line 5 years. And we know that it's operating income minus whatever your depreciation would be, which is this. And your tax rate is 25%. It talked about, so after the straight line method, it talked about there's no terminal value, ignore the half-year convention. No terminal value, so we know terminal value is 0. So you add these two together, should give you 5,500. These are everything that's relevant. Everything else that I mentioned there is not relevant cash flow for this problem. So, NPV. Net present value. Second question, find the net present value. So whenever we do NPV, it's always your initial investment, then you add up whatever your incremental cash flow is, and then your terminal value. And you know usually your initial investment is a negative number. Change in cash flow plus or minus your terminal value. In this case, your initial investment at time 0 is this much. And this is the present value, so you don't have to, convert it or anything. So, $20,000. Your incremental cash flow, which is over here, this occurred from year 1 to year 5. And you know that this amount of money at year 1 does not equal to this amount of money at year 0. So you're going to find the present value of this amount for the next 5 years. And you go back to your chart, you look for basically, they call it PVAF, present value annuity factor, 16% in 5 years. And then you know this is 0, so you just add them together, which should give you negative 1993. Any of you guys taking finance right now? If so, then this will be easy for you. You will understand what's going on. Or, yeah. Okay, so the factor is 3.274, if you guys are wondering. It's basically saying, draw a timeline. One, clearly my timeline is not that great. You're purchasing a product at this time, year 0, which costs you negative 20,000. But in the future, you'll be getting 5,500 every year as your incremental cash flow from tax or from operating cash flow resulting from this investment. It's basically asking you whether getting these incremental cash flow will be enough to cover this initial cost. And what we're saying is the 5,500 at year 1, 2, 3, 4, 5 does not equal to 5,500 at year 0. Because the money, $1 today is not $1 tomorrow. So that's basically what we're saying. So to find how much 5,500 for every single year for the next 5 years would be at today's value, then you find the present value annuity factor. You time it out. This would be how much 55,000 would be for the next 5 years. So when you convert it back, this might be something around 5,000. This might be something around 45. Let's say this is something around 4,000. You add them together, that would be what this is. I made up these numbers, but then you know that it will be a smaller number than 55 because $1 tomorrow is less than $1 today. So that's basically what you're looking for. You guys don't do the calculation. Basically, you look for the factor, you time it, and they just give it to you. Last question, payback period. So very similar to what we did on the top. Basically, your investment, 20,000 divided by your incremental cash flow, which is 55. You ignore the time value of money and you think, oh, okay, this will give me, I should be able to get it paid back in 3 years, a little bit over 3.5 years. So for this problem, what do you learn from the NPV analysis and what do you learn from the payback period? Okay, so I mentioned earlier, basically we're trying to find out from the NPV analysis, is the net present value bigger than 0? If it is, it means this is a good investment. If it's not, then it is not a good investment, right? So since it's negative, it means that even if we're generating $5,500 every year for the next 5 years, we're not going to be able to break basically the break-even term from today's investment. So it means we should not be investing in this project. This is if we take into consideration of the time value of money. When we're calculating payback, we don't care about time value of money. We're not saying, oh, $5,500 for the next 5 years is not 55 every year. We're gonna, find the net present value of, the present value of 55. We're not doing that. We're just saying, okay, we assume $5,500 is $5,500 every single year. It's the same value. What we find is that the payback period to make this investment break even, we only need 3.65 years, which means this should be a good investment, right? Because we are paying back sometime here. Does that make sense? But we know this doesn't make sense because according to the NPV analysis, it's negative. So if we take into consideration of time value of money, this is not a good project. It's negative. If we ignore time value of money, this is of course a good project. Because if you think about it, 5,500 for the next 5 years is definitely greater than your 20,000 investment, right? If you time it out, it is greater. That's why your payback period is smaller than 5. But that's because we didn't take into consideration of time value of money. Does that make sense? So it's giving you two different results, but you gotta understand why. Okay, next question. The manager of the hardware store believed that the demand will ensure the ability of purchasing this blah blah blah. Explain why the hardware chain's manager cannot be certain about the future demand of the sprinkler head. This is just where you come into being creative. You can talk about what you learned in econ. You know, there's competition, the competitive price might decrease, so you know they will not be purchasing at the same price that you're selling right now, which means that your forecast is not accurate. There might also be new technologies coming into place, which you learned in first year econ. You know, technology shifts the demand and supply, right? Or it only shifts one. Clearly, I don't remember, but technology certainly will change something, so you can talk about that. Weather pattern will also change the demand. You know, if it's raining every single day, why would I need a sprinkler? I'm not. Yeah. So these are just something you can be creative, whatever you think of, just write it out. Discuss how uncertainty for the hardware store could lead to uncertainty for irrigation supply. So, if the irrigation supply company relies on the hardware store for a portion of the contribution margin, any changes experienced by the hardware store will have an effect on the irrigation supply. So they are linked. So if one is uncertain, another is of course linked to it itself. If the portion is small, the effect will be small. If the portion is large, like the portion of the contribution margin, then the effect will be quite large. Oh my God, the last problem is so long. Holy. Okay, let's get this rolling. Another MPV? Oh no, it's not. Chapter 13. What is chapter 13? 46. Choice of transfer price. Fairness to manager. Wow, this is so long. Okay. Let's take a look. So this company has two large subsidiaries, oil and chemical. Oil is an oil refining business and its main product is gasoline. Chemical produces and sells a variety of chemical products. You know what? I need another board. Okay. So chemical owns a processing plant, polystyrene processing plant next to oil refinery. So this plant was built at the same time that oil built its benzene plant at the refinery. Benzene is a raw material needed by chemical to produce polystyrene. Chemicals manager believe that they can sell 50 million kilograms of this per year, which is less than the full capacity. Following the chemicals' expected revenue and cost for this unit, volume is measured using weight in kilogram rather than using liquid measures such as liter, because weight is not affected by temperature. Interesting. So it tells you selling price, cost, but give you the variable and the fixed. Oil can operate at full capacity and sell all of the gasoline it produces. Following are oil's expected revenue and cost. So it gives you everything. For every kilogram of benzene that the oil produces, it will forego selling a kilogram of gasoline. However, 50 million kilograms per year would be only a small portion of the total volume at the refinery. Following the oil's expected revenue and cost for the production of benzene. These costs include the cost of refining the crude oil. So on a company-wide basis, should this company produce basically this new product this year? Why or why not? So let's look at everything they gave us. There's interesting. Transfer price. So this company, they have two business lines kind of, and then you need to find out the transfer price between one to another. So, what should we do? There's two options, and we know when we're talking about this kind of scenario, fixed costs are not relevant because it is unlikely that they would change under the two options. So fixed costs, we can ignore it. So we need to look at the contribution margin for each option. So the first one we look at is contribution margin for 1 kilogram of gasoline. Selling price, crude oil, variable production cost, which gives us the net. So if you look at the second part, so it says oil can manufacture blah 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 and then sell all the gasoline it produces. So the selling price is 16 cents per kilogram. And then it talked about the cost of crude oil, which is 6 cents. And then we don't care about the fixed cost since it doesn't really have an effect, right? It's irrelevant. So we only look at the variable cost, which is 2 cents. And if you subtract them, your contribution margin will be 8 cents per kilogram. If instead we're making this new thing, so contribution margin for 1 kilogram of, so selling price, what does it say? Which is, if you look at the top, the selling price is 30 cents. And, oh, I need to write down more since they have different chemical variable production cost, crude oil, and then oil's variable production cost. For benzene. So on the top it says, the variable production cost is 3 cents. And the cost of crude oil, which is the same, 6 cents. And the oil variable production cost, which is on the bottom, which you can see is 4 cents. If you subtract those, it will give you 17 cents per kilogram. So we know if we do gasoline, it will be 8 cents per kilogram. If we do new one, then it will be 17 cents. So the additional contribution margin cannot do math. Compare those two together. And how much, so this is per kilogram, we need to understand, should they be selling it this year? So how much profit will they be making? So they said 50 million kilograms per year will be sold, kind of thing. So the expected quantity of sold is 50 million kilogram times expected quantity. So your P times Q again, which is 50 million, times them together, which should give you 4.5 million. So they're making money. Which means they should be selling it. Second question. Using the usual quantitative rule for the short-term decision, what is the maximum price that the chemicals manager will be willing to pay for benzene? So, where can I write? I'm going to write it there. So the usual quantitative rule for short-term decision is the maximum transfer price the chemical willing to pay is the price at which chemical's contribution margin for benzene is 0. Oh my God. So contribution margin for benzene is 0, which means so the chemicals manager will be willing to pay up to 27 cents per kilogram of benzene. So will they be willing to pay for that price? Of course not, because if their contribution margin is 0, it means that they are incurring an overall loss once you take into account of the fixed cost, right? Which means that even the company overall will be making a profit, But for this subsidiary, they will be making a loss. So they're not willing to pay for the maximum price. What does the next question ask? Will chemicals manager be willing to pay for the maximum transfer price calculated? Of course not. Because if you consider the fixed cost, then the subsidiary itself will be losing money since the contribution margin is 0. Using the usual quantitative rule for the short-term decision, what is the minimum price oil manager will be willing to receive for benzene? So the minimum transfer price they will be willing to receive is the price equal to the contribution margin that oil gives up, which is this, 0.08, so 8 cents, plus the additional variable costs they incur if they, produce benzene. So the incremental variable cost. So it will be this plus which is 10 cents per kilogram. This is the incremental variable cost for benzene. Are we almost done? Yes. So, next question. Would oil's manager be willing to receive the minimum transfer price calculated? I will guess not. They would not be willing to accept the minimum transfer price because because chemical will receive all of the company-wide incremental profit, but oil can actually sell all the oil it produces, right? As mentioned in the text, they can sell everything they produce. There's a high demand. So why would they want to sell you for the minimum transfer price, whereas they can sell the gasoline to other people, for a different price, and they will be making money. So of course, there's no incentive for them to produce just for another subsidiary and not making a lot of money on it, because each subsidiary or the business line will be kind of evaluated on its own. So they would not be. What transfer price might be fair to manager of both subsidiary? Explain. So, this is the, sorry, let me write it out. This is the min, and that's the max. One company is not willing to pay for this amount. Another company, one subsidiary is not willing to pay this amount. Another subsidiary is not willing to sell for this amount. So if they can come to a compromise, something in between, then it is a fair price. So anything between 10 cents and 27 cents. We're guessing it might be closer to that amount, just my guess, because they can sell everything they produce. So they have a better bargaining power, whereas they don't. Am I done? Awesome, I am.